What is good, YouTube? It's Teflon Don, and this is another YouTube video where we'll be continuing on candlesticks, and we will go down deeper into market structure, candlestick patterns, etc., etc. From the Candlestick Bible. I'll leave a link in the description below so that you can find where you can download the PDF file, and hopefully you can use it to your advantage as you embark on your trading journey. With that being said, we're going to get straight into it. Let's get started. So this is basically just going to be an audio commentary, and you can read along, you can just listen to my voice, whichever you like. It's just for you to get a base knowledge of candlesticks and, understand them on a deeper level and how they're formed and what their formations mean. So let's get to it. So candlestick pattern exercise. So now I think that you get some information about Japanese candlesticks. You know the anatomy of each candlestick and the psychology behind its formation. Let's take this exercise to test your knowledge and see if you still remember all of the candlesticks we talked about. Look at the chart below and try to find the name of each candlestick number and the psychology behind its formation. So looking at the chart below, we'll see number 1 is a bearish engulfing. Number 2 is a tweezer bottom. Number 3 is a bullish engulfing. Number 4, bullish engulfing. Number 5, another bullish engulfing. Number 6, I'm not too sure. And number 7 would be also a bullish engulfing. So if you can easily identify these candlestick patterns and you understand why they are formed, you're on the right path. But if you struggle to identify these patterns, you'll have to start learning about them again till you master them. So let's try to answer the questions concerning the candlestick patterns on the charts above. Number 1 is a bullish Arami pattern in sidebar. The formation of this candle pattern indicates indecision in the market. In other words, the market was consolidating during the session. Number 2 is a bullish tweezer. The market was trading up, sellers tried to push the market lower, but the reaction of buyers was more powerful. This pattern represents the battle between sellers and buyers to take control of the market. Number 3 is the engulfing bar. Sellers were engulfed by buyers. This indicates that buyers are still willing to push the market higher. Number 4, number 5, number 6, all engulfing bars. And number 7 was our Arami pattern. And this pattern shows us that the market enters in a consolidation phase during this session. So buyers and sellers are in an indecision period, and no one knows who is going to be in control of the market. Let's take another exercise, look at the chart below and try to figure out these candlesticks. So number 1 is a bullish engulfing bar. Number 2 is a hammer. Number 3, which is the larger body, it's a hammer, which is the larger body plus the smaller body, equal to a Arami pattern. And number 4 is a bearish engulfing bar. I want you to open your charts and do this homework over and over again. You'll see that with screen time and practice, you'll be able to look at your charts and understand what the candlesticks tell you about the market. Don't worry about how to enter and exit the market for the moment. Take your time and try to master the candlestick patterns discussed in the previous chapters. In the next chapters, I will arm you with techniques that will help you identify the best entry and exit points based on candlestick patterns in combination with technical analysis. Trust me, these price action strategies will turn you from a beginner trader who struggles to make money in the market into a profitable price action trader. So the market structure. One of the most important skills that you need as a trader is the ability to read the market structure. It is a critical skill that will allow you to use the right price action strategies in the right market condition. You're not going to trade all the markets the same way. You need to study how the markets move and how traders behave in the market. The market structure is the study of the market behavior. And if you can master this skill when you open your chart, you'll be able to answer these questions. What the crowds are doing. Who's in control of the market, buyers or sellers? What is the right time and place to enter or exit the market? and when do you need to stay away. Through your price action analysis, you'll experience 3 types of markets: trending markets, ranging markets, and choppy markets. In this chapter, you'll learn how to identify every market and how to trade it. So this will be the last chapter before we come to the end of the video, and we'll have a continuation later on. So number 1, trending markets are simply characterized by a repeating pattern of higher highs and higher low in an uptrending market, and lower high and lower low in a downtrending market. See the example below. As you can see in the example above, the market is making a series of higher highs and higher lows, which indicates that the market is uptrending. You don't need indicators to decide if it's bullish or bearish. Just a visual observation of price action is quite enough to get an idea about the market trend. Look at another example of a downtrend. And another hack that you could use to identify the trend is to just turn your candlesticks into a line graph, then get a clear direction, then go back to your candlesticks, because the line is just gonna be more clear. It's just gonna go one way. It's not gonna really divert and confuse us. Candlesticks may be a little bit more confusing in different markets because of the structure, but at that point as well, if you see that you can't identify the structure, stay out of the market, stay out of the trade, because it's most likely ranging. The example above shows a bearish market. As you can see, there are a series of higher lows and lower low, which indicate an obvious downtrend. Trending markets are easy to identify. Don't try to complicate your analysis. Use your brain and see what the market is doing. If it is doing a series of higher highs and a higher low, it is simply an uptrend market. Conversely, if it's making a series of lower highs and lower lows, it's obviously a downtrend market. According to statistics, trends are estimated to occur 30% of the time. So while they are in motion, you've got to know how to take advantage of them. To determine whether a market is trending or not, you have to use bigger time frames, such as the 4-hour time frame, the daily or the weekly time frame. Never try to use smaller time frames to determine the market structure. And why they say never use smaller time frames to determine the market structure is because smaller time frames move more erratically, so they'll give you a lot of fake outs, a lot of fake uptrends. You'll think it's going to go up, then it goes down, then it goes up. It'll be hard to identify because they're very choppy and they move much more often than the larger time frames. And another thing, when you are trying to identify market structure, don't complicate it and be like, I'm a grown up, maybe I'm an engineer, I'm a doctor, or whatever profession that you do at a high level, and try to overcomplicate the process of identifying market structure. Go back to that kindergarten, junior school mindset that you had, where things were just simple and as they were. There was no trying to go into details or anything. Just look at it on the bigger picture and use that mindset of a kindergartner, that simplistic ideal mindset, to identify market structure, because it's that simple that even someone who's 12 can identify the market structure. Even someone who doesn't trade can identify market structure. If you just show them the charts and show them, hey, what direction do you think this is going in? Listen to their answer. Most likely that's the correct answer because it's so clear and obvious. If it's not, then it's most likely ranging. How to trade trending markets. If you can identify a trending market, it'll be easy for you to trade it. If it's a bullish market, you'll look for buying opportunity because you have to trade with the trend, and if the market is bearish, you have to look for a selling opportunity. But the question is, what is the right time to enter a trending market? Trending markets are characterized by 2 important moves. The first move is called the impulsive move, and the second one is called the retracement move. So look at the example below, get a clear picture of, the impulse entry, the retracement, the impulse, the retracement, impulse, and you see that it's a constant build up that leads to maybe consolidation, or it's going to lead to a downtrend, a reversal. And always trade with the trend, never trade against it. So if it's in an uptrend, just stick to your buys that today I'm going to be looking for buys. Selling opportunities are going to come, but once you decide to take those, you're going to confuse yourself. As you can see, the market is making higher highs and higher lows, which indicates a bullish market. If you see this market, you will think of buying, but as you can see, the market is making two different moves. The first move is an impulsive move, and the second one is a pullback or a retracement move, a correction move. Professional traders understand how trending markets move. They always buy at the beginning of an impulsive move and take profits at the end of it. This is the reason why the market makes an impulsive move in the direction of the trend and retraces before it makes another impulsive move. If you're aware of how trending markets move, you'll know what the best place to buy is at the beginning of an impulsive move, at the bottom of the move, not when it's exhausting. And traders who buy an uptrend market at the beginning of a retracement move, they get caught out by professional traders and they don't understand why the market hit their stop loss before moving in the predicted direction. So that's a reoccurring theme, especially for beginners, where most likely your analysis will be correct, but your timing of your entry is wrong. So you might enter too early or too late and you see price come back to your stop loss and eventually move in your direction, then hit your take profit. It's a very stressful situation. So looking at the illustration above, it shows a downtrend, and as you can see, the best trading decision is to sell the market at the beginning of an impulsive move. If you try to sell in the retracement move, you'll be trapped by professional traders, and you'll see, and you'll lose your trade. Now we know how to identify downtrends and uptrends and how to differentiate between an impulsive move and a retracement move. This is very important for you as a price action trader to know. But the most important question is how to identify the beginning of an impulsive move to enter the market in the right time with professional traders and avoid being trapped by the retracement or the pullback. To predict the beginning of an impulsive move in a trending market, you have to master drawing support and resistance levels. So what are support and resistance levels and how to draw them on our chart? That's going to be in the next chapter, and that's going to come to the conclusion of this video. And just a side note, just to tell you guys that with market structure, it's very important, especially for price action trading. And you need the fundamentals, which are very basic and they're not difficult to understand on a shallow level. And the more you look at it from a baby perspective, the easier it's going to be for you, because when things are simple, it's easy to identify opportunities as opposed to when it's complicated. That's why they say go to the higher time frames, because the higher time frames are going to be much more simpler to understand than a lower time frame, because the lower time frame moves erratically because it's happening in a shorter space of time. So just understand that, and then study up on your candlestick patterns. Try to memorize them so that when you see it occurring in the market, you can see that your pattern has formed and it's giving you a confirmation to take the trade. Do not hesitate, because you have your confirmation, you've done your research, you've studied, and because of that, you have confidence. You're not cocky, you're fucking confident, my guy. And because of your confidence, you're gonna have a higher probability of taking a good trade as opposed to taking a trade where you're not too sure, you have no confirmations, you have no confluences. With that being said, it's your boy OTG, Only Traders Gang. Merch coming soon, definitely. Deuces, baby.